Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. We're just setting up Ross Gerber of Gerber Kawasaki. You won't want to miss this interview. He's got 30 years of experience. He has been through the worst of the worst when it comes to tech investing. And he's a stock picker, but he's also a storyteller. And he tells us a lot of fascinating stories about Elon Musk, Steve Jobs, Tim Cook, Jensen, Huang, all these big name CEOs. You won't want to miss it, so let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO Investor Line. We all want to make the most of our investments. That's why BMO Investor Line is here. Their easy-to-use platform, packed with tools, resources, and commission-free trading on over 100 popular ETFs, can help you trade with confidence and take control of your financial future. Learn more at bmo.com/online investing. Ross Gerber, thank you so much for joining me on the podcast.
Thanks for having me.
So you are Mr. Tech. When I think about tech, I think about Ross Gerber. So I'm going to ask you, why is tech the worst performing sector of 2025 so far?
Well, it's been a pretty good performer for the last few years. So to start off the year a little bit down is not surprising. I think also you have very high valuations in technology stocks in the market. So, it's not a bad thing to have valuations come down if you're a buyer.
It's not a bad thing, but it is a bad thing maybe if you were holding thinking this year is going to be just like last year. Do you think that there's a risk of a repeat of 2022? And as a refresher, that was a year when interest rates were going up and tech was hit the hardest by that.
Yeah, I don't need a refresher on 22. It was one of my toughest years since the financial crisis. So yeah. What caused that, and there were several factors that made 22 extremely hard, one of which was the Ukrainian war breaking out 3 years ago, this month, and the inflation that it triggered, along with a really overly aggressive Fed because they were behind the ball with inflation. So you had this confluence of events in 22 that basically crushed, stocks, and certainly the S&P showed part of it. But if you look at the other indexes, the NASDAQ and the Russell, stocks were crushed in 22. That said, we've had a nice rebound into 23 and through 24. And, it's been a pretty good run. So, any investor that thinks any one year is going to be like the year previous is going to be mistaken 100% of the time. So you have to understand that investments now work in real time based off what's happening in real time in the markets and in the economy. And so we see higher volatility than we've seen in the decades previous. And so the certainty that people expect when there's high valuations is a false certainty. When you have lower valuations, you can have more certainty of return. So it's very hard to predict, where markets will go on any short-term period of time. But what matters the most is whether earnings are going up in the companies we own. And so far, that looks like it's going to be pretty good for this year.
Well, let's talk about that. You mentioned valuations, and I feel like that's people's favorite excuse about why they don't like a tech stock that's up 300% over the last year. I feel like, and I think the data mets this out, is that valuations is not always the best predictor of returns when you're talking about investing in tech. How do you think about that?
I think you don't manage $3 billion like I do. So it's extremely stressful when you lose, let's say, $100 million in a week. And so valuations matter a ton, actually. And, we argue about this a lot in the firm because let's say you like a stock that has 100 PE or 150 PE like Tesla, and you're like, oh, Tesla can just go higher and higher. That's not true. The earnings have to go up over time for a stock to go up over time. And when I say over time, let's say over 5 to 10 years. So when you look out like today and you say, what will earnings be in 5 years? It's very hard to predict. But if earnings growth, let's say, averages 20% a year for the next 5 years, if your PE is very high, it's already taking into account that expectation. But if your PE is more nominal or lower, your return potential is substantially higher. And that's how I've made money like over 30 years in the stock market, is actually through earnings growth and PE expansion in the companies I own versus buying high PE stocks, hoping that earnings will continue and the PE won't shrink. So it's much harder to make money if you pay more for something than if you pay less for the same level of growth. I mean, it seems like that would make sense.
You sound like somebody who's more cautious on the tech sector, maybe a little bit more selective given how big the sector has become.
Cautious isn't the right word, because I'm overweight technology and I own Bitcoin, for example. It's more that if I own Nvidia, which is one of my top holdings, let's say, and Nvidia historically is traded at, let's say, a 40 to 45 price earnings ratio, and it's grown its earnings by a rapid amount, well over 100% over the last several years. And so it's very hard to value Nvidia right now. But at 30 or 35 forward PE with a 40 average PE over time and growth rates that are through the roof, Nvidia is cheap in my mind. But you can say, oh, it's worth $3 trillion or whatever. But I'm like, they're making like, 15, $20 billion a year profit and growing very rapidly. And they have a monopoly on one of the most important technologies in the world. So what you might pay for something, then you've got companies like cybersecurity where valuations are ridiculously high compared to the earnings the owners get, and it's a much harder sector to invest in and much more volatile. So how you value a tech stock is very much related to its history, its growth rate, and what its future brings.
Let's talk about Nvidia in isolation. Obviously, the poster child for AI enthusiasm, one of the main beneficiaries of spending for artificial intelligence, because you need their chips in order to enable a lot of the technology. I'd love to get your thoughts on whether we actually need their chips, because DeepSeek was able to do something with kind of lower grade chips. But generally, if there is a bear case, it's this idea that, people are overestimating the amount of the demand that is going to be necessary. And there's a risk that we're going to overbuild. We're getting too enthusiastic about AI and that we're going to overbuild. And Nvidia is not going to be able to keep doubling or keep its momentum up.
When you look at AI models like DeepSeek, it's really a fraud. DeepSeek doesn't actually use its own proprietary AI. In a way, it's like advanced search. And this concept of reasoning models versus the original, like ChatGPT models. And we've tested this now extensively, and it's crap. It's crap because it's pulling data from bad sources quickly to give you answers because it doesn't have access to really good data. And that's really what matters with intelligence, is how good your data is. Like, for example, if you're somebody that is really smart, but you only read the tabloids, how good is your intelligence, right? And so reading the New York Times and the Wall Street Journal every day would probably give you better intelligence about, let's say, business news than reading Twitter, for example. So social media data feeds, for example, aren't very good in my mind when you're building like accurate data models versus, let's say, traditional media sources, which I think have a lot more journalism and a lot more data, or encyclopedias and things like that. So what I think is if you're really going to build intelligence, you actually need a ton of chips and what we call accelerated computing, which is what Nvidia has sort of shepherded. It's not really just about running large language models and answering simple queries. It's really about building a database like on your Salesforce, for example, or on your Bloomberg that can really be intelligent based off what you actually use it for and the knowledge that you need to be successful in your, let's say, career. And so right now, we're literally at the beginning of this massive revolution of intelligence where even chat, which I still think is the best model overall, and I use Perplexity a lot too, but chat is the best overall, and it still doesn't really know anything about the stock market. So if you ask any of the AIs any like tougher financial like work, it can't do it yet. It just doesn't have the data. So we're just at the beginning, and Nvidia, there is no second to Nvidia. If you're going to compete in the future, and this is not only for national security, but it's also for business dominance, having accelerated computing data data centers is going to be the key to advanced computing and really teaching all of our computers and devices to be much smarter. And we were just joking about Siri before the show about how dumb Siri is and how annoying it is. Like, imagine if Siri was actually helpful. So, we're just at the beginning.
So here's a question. What is your general time horizon? How nimble are you? How quickly are you in and out of stocks?
Well, I started investing when I was a kid, and I still own some of the same stocks. And so I think a really good stock picker picks a stock they don't have to sell. There's only a few of them that I've owned over like the majority of my career, like Apple.
What are they?
Like I've owned Apple my whole career. I've owned Disney my whole life, for good or for bad. It's had a little bit of a bad run the last 5 years, but I think they're going to get back on track. I've owned Nvidia for over a decade, and Tesla for over a decade, Bitcoin for over a decade, and Netflix as well. So those have been some of my biggest winners as far as like just massive returns, 100 times my money returns, which very few investors have done with millions of dollars. So hence, I guess why I am where I am. But so there's only a few companies that are so well managed through thick and thin and good and bad markets and financial crises that you don't have to sell and you can hold forever. And Microsoft's another one of those stocks too. I haven't owned it as long because of Ballmer. I didn't own it during the Ballmer era, but after Ballmer, I invested in Microsoft and Google as well. So there's opportunities even if you're late, but if you own these great companies over time, they're going to produce very, very good returns for you. And there's not that many. They kind of call it the Mag 7, but there's a reason why they're there. And it's because they've been wildly successful businesses. And that's why so many people own them, and they continue to be wildly successful businesses. So it kind of makes my job easy is, if you stick with winners, you just let them run forever. You don't have to think about it. Where we sell stocks is when they don't perform. So I make many investments that don't perform. So don't think that there isn't a process. But what makes a good investor...
What's an example? Let's use an example to kind of highlight the process.
Well, like I sold Supermicro, which you brought up recently, when, the people at Hindenburg brought up the fraudulent issues with Supermicro. And I trust these people actually because they do a lot of hard work. I know a lot of short sellers through the Tesla days, Hindenburg and Carson Black. So, I actually have a lot of respect for these people because they bet against markets, which is really hard. And they can't really do what they're doing and not get sued if they're lying, So when I saw fraud and sort of the issues involved with Supermicro and then the stock started dropping, I just get out. I was up big on it. I took my money and ran. And, it's gone down a lot. Now it's kind of come back a lot, but it doesn't change that the underlying risk of fraud is still there in my mind. And there's other players like Dell that do the same thing that I think are in a great position with a super low valuation. So, I have no desire to be involved with companies that might have risk of fraud or they don't deliver. This happens a lot where the CEOs make promises and they're going to produce certain numbers and have certain products or services come out and it just doesn't happen. And then the companies don't perform as well. And then you have to move on. So having discipline on selling stocks that even you might like, but just aren't performing, that's sort of the other side of the game. And so there's lots of stocks I buy that don't perform and get sold.
Well, and Microsoft is kind of a great example because you used the Steve Ballmer era. And I just pulled up the data on Bloomberg. Over his tenure, the stock was up like 4% on an annualized basis, and under Satya Nadella, it's up 26% on an annual. So it's a huge gap. So you moved in, you moved out. Supermicro is interesting because sometimes those really scary, hairy stories can be where you can make some money. And so I know that it kind of imploded after the short seller, and then they couldn't file their reports. Now they're saying, hey, we're going to file our reports. Hey, sales in 2 years are going to be $40 billion,
yes.
Not the 30 that you thought. Like, just ignore, what has to happen in the next couple of years. So does that make you nervous? You don't go into those stories that have a lot of hair on them.
No, I don't want to be involved with fraud. See, here's the issue. So you have CEOs that just tell it as it is, even if they have a bad quarter or whatever. It's like, this is why and trust. So management and trust is one of the three pillars that we invest on. So management and products is one of the pillars, fundamentals is the second pillar, and then the third is technical analysis. So all three pillars are important to us, but management and products is the most important to us because management is the edge that I have. Understanding the people who run a business is much more important than the business itself in a lot of ways, because there's just winners that you want to bet on, even if they're crazy, like Elon in the old days,
Is he the GOAT, like the greatest of all time?
Well,
like when you're talking about
was.
these leaders, yeah, he was.
He was, but like many goats, they have their time and then their time passes. And, Elon's one of them, just like
Who's the
Tiger
new
Woods.
GOAT? Who's the new GOAT?
Well, Jensen Huang at Nvidia is GOAT like 1,000 times. I watched these interviews with this guy. He's like, I don't eat, I don't sleep, I work, 24 hours a day on Nvidia, like all he cares about. He'll die for Nvidia. So I want to invest with people like Jensen, and that's what I do. Like Satya, when he took over Microsoft, we were like, well, it's about time somebody who knows how to run something takes over, and Ballmer buys the Clippers, which was so appropriate, like Ballmer running the Clippers is just like when he ran Microsoft, and he built this $2 billion stadium for no reason. But that said, I bet on Tim Cook. When Steve Jobs died, I was telling the story the other day. When Steve Jobs died, I was a big Apple investor, and it was one of the hardest things ever because he lied about being sick with cancer, and nobody knew. And the next thing you know, it was like, oh, I'm dying. And 3 months later, he was dead, and it was crushing. Like, I can't even, like most investors don't remember this, but like it was crushing, it was over a decade ago. And clients were calling me, that was our top position, like, are we selling Apple? Like Steve was the guy. And I was like, look, Tim Cook has been sort of like made for this job. And like, let's just give him a chance. I'm not a huge fan in the sense of he's not Steve Jobs, but he's been working with Jobs and he knows how to run this company. So Jobs seeded Apple with so much innovation. It wasn't until recently where he kind of ran out of Steve Jobs' innovations to promote. And Tim Cook's done a wonderful job at Apple, a wonderful job. And I'm sometimes critical of him because he can't innovate anything, but he's executed brilliantly. And that's kind of what Tesla needs right now. Like if Tesla had a CEO that just executed on Elon's vision, I think it'd be the same thing as Apple. Like I would be much more bullish on Tesla if they had a CEO, but they don't.
That's so interesting, because everybody, I think, put a lot of pressure on Tim Cook to be the next Steve Jobs. And he's not that. In many ways, he's the total opposite of that. But he's a relentless operator, right? The wheels don't really fall off of Apple. You could say, fine, they're not innovating, but the wheels are not falling off.
And the products are great.
The products are great. They're a cash flow machine.
Right.
So is that good enough for you to hold Apple? Like, are you done? Have you put the dream to rest that
No.
they're going to innovate? And
No.
is this good enough?
No, in fact, Apple has a lot of opportunity in the AI era, as we all will need new AI devices at some point that can run much higher levels of computing on our desktops and laptops for security, really. Because, when you start running all your pictures through AI, do you really want that held on a server somewhere versus on your device? And so your device has to have a certain amount of power to run AI on it. So there's an upgrade cycle that hasn't started yet for Apple, which I was hoping would start already. That's going to happen over the next, let's say, 5 years as everybody moves to much better devices. But because we trust Apple with our privacy, this will allow AI to be much more personal for what we need it for. Like, can you please pull up all the pictures from my birthday over the last decade because I want to watch them all, at once. Well, Apple can't come close to doing that today. It's starting to get more intelligent. Like you can pull up pictures from Hawaii because it has the location saved, but it's going to learn everything. Now, do I want that on iCloud or on some server in China? No, absolutely not, which is another issue with DeepSeek, is that it's basically a Chinese government tool. But besides, that, I think Apple has a place in people's lives that no other company has, and it's not going to be usurped by anybody.
Absolutely. We're going to dig into specific questions on stocks, but before we do, love for you to address sort of the number one bear thesis on tech stocks broadly. People love to make comparisons between now and 2000, and particularly looking at, there's all kinds of metrics that they use. One that I'll just pull out is like the concentration, the percent that the major tech stocks make up of the index is now higher than it was in 2000, when there was all this excitement over the internet. You've been doing this for 30 years. So you've lived through all the cycles.
So I was there.
So you were there and you came back, you didn't let it burn you. What do you say to that? How do you think about it? What gets you through that fear, if you have any?
Well, dotcom, and I certainly lost in 2001, and September 11th also was in that period of time, and 2000 meltdown was difficult, and then that bear market was 3 years. It was 2000 to 2003, so it was the longest bear market that I've ever lived through. It was 3 down years in a row. It was brutal, and after 2 years, I remember saying it's never been in 3 years. We should buy stocks, and then it was like a third year, right? And then we invaded Iraq in 2003, and I was like, all right, this is bullish, and I went all in 2003, and it paid off for the next few years, and I made back my money. So that was a tough time. But when you look at, I used to go to these meetings in 99. Okay. Now, to put it in perspective, the difference between .com, everybody was worried about Y2K. I don't know if you remember, if you were there, but
I do. My lights were on.
Okay.
The lights stayed on.
You look young, so you might have been like a kid. But it was this idea that all our computers were just going to break because of this. Yeah. And I would go on my Microsoft and go, I don't see why this won't work tomorrow. So we didn't buy into Y2K, and we kept investing. And from June of 99 to December of 99, the NASDAQ doubled. The entire market doubled. Now, I literally tell this in meetings, guys, imagine if the stock market over the next 6 months doubled. Okay, nobody can imagine that. I mean, I managed $3 billion. Imagine, I would make billions for my investors if that happened. That was the kind of money that was being made in .com. And I was young at the time, so I didn't have a ton of money, and I ended up making a decent amount of money during .com, but today, if that happened, oh my God, I would be very happy. But it wasn't based off earnings. It was based off hope. And I always use this story. I went to this company, it was called Net Zero. And it was basically, we're going to give you free internet. And I was in this roadshow meeting, and I remember saying oh, well, if you don't charge for internet, how do you make money? And how do you value the company? And they're like, oh, we're not worried about making money. We're going to give away the internet and we'll figure it out later. And the valuation is based off hope. So it's like a price to hope ratio. And I remember them saying this, and I was like, I'm out.
They didn't say that. They didn't explicitly say it's a price to hope.
They said it was a price to hope ratio.
Stop. Oh my God.
Yeah.
If ever there was
that's
a
why I
sell
tell the
signal.
story, because I was like, it would remind me of when I was in the mortgage crisis, during financial crisis. The firm I was working with was through AIG, unfortunately. And so I lived through that disaster too. And banks would come and try to get us to sell mortgages. And they would try to sell us these variable rate mortgages that were just garbage. And I remember saying I like fixed rate mortgages. Why would you not want a fixed rate? And they're like, you're an idiot. Why would you lock in your rate for 30 years? You could get such a low rate today. And sure enough, 3 years later, the whole thing melts down. So when people come to you with these fanciful, get rich stuff, you should immediately be concerned. And so if too many people are too bullish on the stock market, you should be very concerned. So I actually really love bears. I love bearishness. I love everybody's worried about inflation. Everybody's worried about the Fed. Everybody's worried. Every time they say everybody's worried, that's good. When everybody's like, this is great, you should be an investor. Oh, you're an idiot, you're not investing in this, or this. Oh my God, I'm making so much money. When the guys down the street or your Uber driver or whatever is trading Ethereum, I remember this in 2018. I got an Uber, this guy's trading Ethereum while he's driving me, and I was like, dude, what are you doing? You're an Uber driver, pay attention to the road. He's like, oh, have you seen Ethereum, this and that? I was like, sell, and so you got to really look at sentiment and be concerned, because there's no better predictor of future markets than sentiment.
I think that's
a good point. It's a contrary indicator.
It definitely is. And yeah, fine. You could use the percentage as a comparison like I just did. But then you look at other areas of frothiness, where are the IPOs? We might see them this year.
But that's exactly my point. if the market was great, there'd be IPOs going out left and right because these guys cash in, It's like I've been waiting in private for all these years and nobody's going public because if it's not like a super good company, nobody wants to take the risk. And private markets do have liquidity now. So you don't have to go public if you want liquidity if you're a successful company, including mine. Like I could sell my company right now easily to private equity. There's so much money out there in the private market. So there is a secondary market that's kind of exists now among, I would say, like the wealthy or the private equity funds where they trade, all these private companies in a way, but it's much clunkier and much more costs a lot of money to buy and sell private companies. So that said, we just don't have any of the metrics that worry me right now. Plus we have higher rates. Remember rates are still, 4.25% on the Fed. And so the fact the market's held up, the economy's held up, we have higher rates, IPOs, like this is a very healthy market in a lot of ways. Like for investors, it's a good time to invest, I think.
If the Fed doesn't cut rates this year for the rest of the year, is that going to be a big problem?
Well, no, I tweeted that this morning after the inflation numbers. Trump is inflationary. It's a very different set of policies than Harris and Biden, which were really anti-business and really deflationary in many ways, And so I went from thinking if Harris won, rates would go much lower just to support the economy because they're not business friendly, to then Trump wins and, he throws out all his business stuff, but really tariffs are incredibly inflationary. Just discussing them, prices go up. And that's what we're seeing right now. And it's not energy, it's food and other areas of the economy that are seeing a little bit higher prices because of the anticipation for tariffs. And tariffs will increase pricing and increase inflation. And so I think the Fed's done for now. I think investors hoping that lower rates will create higher PE multiples and therefore higher stock prices. I think the market is adjusting to that now, that is not, we cannot rely on lower rates to boost markets. And so it puts pressure on PE ratios essentially. So you get a higher PE ratio, the lower interest rates are. So there's this expectation in the market, okay, rates are going to go lower. Well, now that you can take that expectation out, markets go down a little bit, you get a lower PE ratio. But, once again, if you're looking at earnings growth, earnings at our companies have never been better. Like we own a lot of Netflix. They just like blew it out. Microsoft numbers were incredible. Google's numbers were great. Apple's numbers are a little bit more boring, but pretty decent. Nvidia's numbers are coming and they're going to be huge. So when you actually look at profits more than, valuations, profits are strong and that will support the market. So if the thought process is that earnings are not going to grow, we'll see a bear market. But I just don't think that's what we're seeing. We're going to see a pro-business environment, and I think earnings will grow.
All right, time now to dip into the mailbag with Ross Gerber. Okay, Ross, our first question is about Reddit. This one coming from Young Guns on Instagram, a fan of the show. Is Reddit the next Meta?
It's a good question. Meta is much different than Reddit in that Meta is an advertising-based company that owns Instagram and Facebook and WhatsApp. And these apps are indispensable in many people's lives, not mine, fortunately, but in many people's lives. And many companies, including my wife's, sell a ton of products on Instagram. So Meta has a very good business in its core from a social media perspective, but it's in communication services in that it competes with, let's say, Google for ad dollars. Now Meta's morphed into more of an AI play. And the question is, well, how do they make money on AI? And we'll have to see. Reddit is a different business in that it really was never a great ad platform. Still, it really isn't a great ad platform. And where they're making money is on data. Reddit data is pretty good, but not great in that they have these interactions about, it's almost like YouTube, you can go on Reddit and be like, what's the best Drano to use or whatever, and you'll get like 100 comments. I've always found Reddit to be clunky and hard to use and not really my thing, but they're making a good amount of money selling their data to AI aggregators, basically. So there's value to their data, and that's hard to sort of reconcile. And they are trying to be an ad business, but I don't like their platform. So if push came to shove and I had to buy
Like you don't
one
like
stock,
Reddit as a platform.
not really. It's not a great platform for users. It's like when you look at Instagram, like a 12-year-old kid can figure out Instagram. They're in it. It's entertainment. You know, Reddit is more like YouTube, where you're like asking questions and it's giving you answers. So I've always felt that the Reddit communities vary greatly. A lot of it's just garbage talk, you know, like the stock stuff is, you know, back when Reddit was really popular with the stock stuff in 21.
Yeah, meme trading.
Yeah,
Reddit
and people would like put stuff about me on Reddit, and I would like go onto Reddit just to see what people were saying about me. And like, you know, it was just this like rambling discussion of random, like YouTube, you know. And so
I mean, like you can't say that Instagram is like this highbrow discussion either, right? It's just
No.
like in a different form. If people
they're
are
selling
there,
you stuff though. That's the difference. Reddit isn't really trying to sell you stuff that bad, where Instagram is, don't be confused. Like the whole thing is about selling you stuff. So, you know, and they do a great job getting people to buy. So the question is, do people really buy stuff off Reddit? No, you can't compete to Instagram. So I think every kid pretty much goes on Instagram every day, and Reddit's audience is much lower. So I would own Meta way more than I'd own Reddit, also because of AI. But Reddit isn't a bad play per se, you know, like as an investor. I would have to get my arms more around the business. The owner of the business is actually a really smart guy. So, you know, I'll give Reddit that. And Reddit does have data, a lot of data. So it's both of those, I think, will be good beneficiaries of the AI era for various reasons. And so if you are comfortable with the valuations, Meta is much cheaper valuation than Reddit. I don't think they're bad investments.
I mean, Reddit is up so huge, up 500%. So might have maybe missed the boat on that.
Yeah,
and I'm
exactly.
surprised to see a stock that's up so much. It still has about 16% of the shares outstanding short.
Right.
That's hefty for a company. Do you ever bet on the short side? Like, would you
No.
look at it on the short side? Never.
I don't short sell for many reasons, but the first and most important reason is I rarely have made money doing it. So, you know, how much money do you want to lose betting against stuff? You know, it's like I learned as a young person, this wasn't my thing. As I said, what I think I'm good at is identifying winners. You know, like what CEO is a winner? You know, like, and then I'll meet these people and I'll be like, all right, I'm putting my money with this guy, you know, or girl. You know, it's like they're winners. They don't always win. They might switch companies and not do as well, but you know, hopefully they have this thing. The second reason is fundamentally stocks are meant to go up. Fundamentally, the stock market's meant to go up. It's capitalism. So companies make more profits and they reinvest these profits. And over time, a good company that's profitable should go up in value. It's just how much is really what matters. So it's an allocation of capital. So just fundamentally, people go, well, the stock market always goes up. And it's like, yeah, it's supposed to. Over time, it's supposed to. So why would you bet against something that you know over time is working against you? So you have to be that much smarter. And in fact, you don't have to be smart at all to make a ton of money in the stock market. All you have to do is buy the S&P 500. It works great. You know, we do that a lot at my firm. We own a lot of the S&P 500. We own a lot of the NASDAQ. We own a lot of my fund, GK, too. It's one way to play the market is my 25 or 30 positions. And it's meant to, you know, make your portfolio a little bit more nimble than just owning the S&P 500. But you're never going to go wrong just owning an index or a series of indexes and saving your money over time. And that's what we really teach investors, not to overthink this. It's the trading that costs you your future. It's the moving in and out of stocks or thinking you're smarter than the market or trying to overthink things. That's how people lose money, okay? The simplest way to be a multimillionaire is to start investing in your 20s and buy index funds or ETFs that are broad funds and hold those and just save and invest your money in retirement plans. And I know Canada has retirement plans too. And just use the tax advantages you have to accumulate assets over your life. Because now I'm 54, but I started as a professional investor at 23. So I have 31 years as a professional, but I actually started investing when I was 13. So like when you think about what the world was even like when I even started in the business, I was the first person to have a laptop at my company. And people fought with me because I wouldn't use the typewriter. For real. I literally had a fight my first week at work because I had his Windows 95 laptop, which was super advanced at the time. And I had AOL, I had email, and everybody in the office had their like phone and a piece of paper and the typewriter to like do stuff. And I was like, dude, I don't use typewriters, you know? And they're like, well, you have to use a typewriter.
You were that guy at the office.
I was that guy. And then I looked at everybody and I said, one day you're all going to have computers just like me. And I bought Dell and I bought Gateway and I bought Microsoft and I bought AOL. This was the 90s. And I was rich within 5 years. So, you know, now I look around and I say, one day you're all going to be using AI like all the time. And that's just what it'll be in 5 years, you know? So you can invest any way you want to invest. But that is, I've been waiting for the theme of the next decade. You know, and it started with autonomy with Tesla, but now it's really grown to AI. Autonomy is one solution.
I think you shouldn't be on Reddit because I think that this whole rant would have gotten upvoted for sure in some sort of group chat. So I like the thinking. Yeah. You're all in AI, and we're going to find out where that is later in the show. You're not so keen on Reddit. Let's get to our second question, which is about cybersecurity. What's your top pick in the cybersecurity space?
So it's CrowdStrike, but we don't own cybersecurity stocks because they're super hard to own. Because the way cybersecurity, I have my own feeling about cybersecurity. I kind of think these companies are the hackers too, to justify the ridiculous fees they charge companies. Because, dude, it's such a scam. Oh my God. You know, we started doing cybersecurity at my firm, and these companies come in, they want you to pay all this money to put software on your computers and all this kind of stuff. And I go, how does that help if somebody fools a customer service worker? So I started doing an analysis to like, how do you really make your company safe from AI? And almost all hacking is social manipulation. It's really just fraud. They're like fooling people in here who work for you or ex-employees who steal stuff. And so cybersecurity is a little bit more like human security and protecting your employees from all the frauds that come their way. Now at my firm, it's every day. Every day somebody tries to steal money from somebody at our firm, and every day we stop it. Okay, we have procedures that no money goes anywhere, you know, unless we talk to people, and we might have to upgrade that to actually FaceTiming people, because now you even have voice spoofing of clients, you know, so like calling them isn't enough anymore. So we might go to like, you have to do a video call with us before you can get money, you know, things like that. Biometrics would be helpful. So, and I just got hacked the other day. My Twitter got hacked the other day, and it was 100% my fault. And I knew it was a bullshit email, you know, and like I double checked and triple checked, and it came from X. And I was like, I know this is, but it was some complaint about one of my tweets, and they were going to, you know, and then I clicked on it, and it took me to an X website. It was completely, but it was a fraud specifically for me. And the minute I put it in my password to like do stuff, my account went down, and a Tesla scam coin posted, you know, like right away. So I was like, I was totally targeted, you know what I mean? And like, it was a really sophisticated hack. And so I emailed Linda Liacarino, because I know her because I'm an investor in X, unfortunately, I guess, or fortunately. And I emailed Linda, and I was like, yeah, it's me this time. It's a crypto scam. I'm an investment person. Please help. And she took it down, you know, right away, because she's great. But it could be, anybody can be fooled by these people if they work hard enough. You know, it's really hard. And so cybersecurity is a tough business. What happens is if you hire a really good cybersecurity expert, they cost a fortune too. So when you look at CrowdStrike, Palo Alto Networks, all the cybersecurity companies, you want to own them because you're like, I want to be in this business. But who really makes the money? It's not the shareholders. It's the people who work there. So the people who work there make a ton of money. And for some reason, the shareholders get a little bit at the end. So if I'm going to own a cybersecurity company, like the opportunity was when CrowdStrike had that problem and the stock dropped hard, we were like, we should buy it. And we didn't. And now it's completely recovered. So I was going to say
totally
that.
Totally recovered and a fresh all-time high.
I know. Thank you for the reminder.
Sorry.
No, because we were waiting for that. And then I didn't pull the trigger, you know. I don't know. Once again, I'm not always right. I'm not always right. But that said, I think you wait for these pullbacks in stocks. Like it could be Reddit or Meta. You want to own these stocks. They'll miss a quarter or something and they'll get hammered. And that's actually when you want to enter those positions. And that's what I'd say about cybersecurity. If you like Palo Alto or you like CrowdStrike, wait till they get hammered for some reason and then get into them because the valuations make no sense.
So you distracted me with the shiny object, which was that you're an investor in X. So I'm not going to let that go. How's that going? How much up, down are you on your money? Yeah, like what does that look like? What does that evolution of your investment look like?
Well, the evolution of my investment originally was, I got into it because I was investing in anything Elon did back then. And when he started buying Twitter, I thought maybe I'd have some influence to like help him, because I'm actually a communications major, been on Twitter forever. I had friends working at Twitter at the time. I knew more about Twitter than Elon for sure. And so I was like, dude, you want to fix the bots, you want to do all this stuff. Like, I definitely know what you need to do, And then they were looking for investors and I reached out and was like, and they were like, you can invest. But then it was like a mess, because he didn't want to invest. And then he was like so then I told my clients, I'm not investing in this for you guys because Elon doesn't even want to do this and it's going to be a disaster. And then I didn't think anything was going to happen. I wasn't sure. And then like the last day they called me and they go, okay, we're going to close this deal. Like if you want to invest, now's the time. I was like, you're giving me one night. So I wrote them a check for my firm and for myself, but it wasn't a big investment relative to my firm, which we manage billions of dollars. So it was a small investment. It was just personal and for my firm. And, pretty much from the beginning, it became clear that, Elon was going to run X and he was going to be the arbitrator of free speech and he was going to do all this stuff. And I was like, oh no, this is going to be a disaster, So that's when I was like, what is he doing? I thought there was going to be a CEO and da-da-da-da-da. And, it's gone obviously pretty downhill from there, where X's revenue is now probably half of what it was when he took over the company. It's not a profitable company, despite some of the news reports that EBITDA was profitable, but they're not taking into account the debt, which make it unprofitable,
right?
Which it's really convenient. Imagine looking at your net worth and just taking away your mortgage and saying, let's not count that. That makes you richer. So, so we had written it down based off Fidelity's numbers, to 75% down. And then they had promised us a 25% stake in XAI as part of owning X. And so that actually did happen. So XAI is 25% owned by X. And then XAI went through 2 funding rounds. They now value it at something like $40 or $50 billion. And so I think X's ownership stake is now around 10% or something like that. But it's worth that like billions of dollars. So let's say that offsets some of the debt, So it was like, well, what's my equity worth? So then sure enough, Elon makes the bet of his life and Trump wins. And Elon's now in the White House with his kid on his shoulders, talking about how much money it costs for people to retire. And, everybody wants to invest in X now because they think, well, maybe we can have some influence, right? Because if I own all the X debt, then Elon owes me money. And if he doesn't pay, then I can take X back. And sure enough, Morgan Stanley was able to sell all their loans almost at par just recently. And that is a score for Morgan Stanley because they were down big on those loans. And so Morgan dumped all their loans this week. And last week, I think it was almost $9 billion at a 10% yield. So investors are getting a nice yield to own Elon's debt. It's actually a really good investment because if he doesn't pay, you can take X from him and XAI. So, I was like, maybe I'll buy some of the debt. But I just recently got a group of investors that wanted to buy my X stock from me. And I told them that I wouldn't even consider it for less than 2 times what I put in. And then they came back and said they would pay that. And so then I came back and said, no, thank you, because I don't sell stocks that are going up, And so I don't know what X is really worth in real life. But I think in hindsight, Twitter is worth a lot of money, especially if somebody could get it away from Elon and fix it. Boy, that would be great. But that's not going to happen. And I think people want to bet on Elon's AI future because he's all in on that future. Despite him not caring about Tesla, he really cares about controlling AI in the future. And he understands the power of this. And that's where he's all in. So, I decided I'm not going to sell my stock. I'm going to hold it, and hopefully I'll make 10x my money at some point. They'll go public, and it'll pay off for me having to deal with all this nonsense.
Okay, that's great perspective on X. Let's get our next question going. This is on Shopify. Would you buy the dips in Shopify? Shopify reported it looked like pretty great numbers.
Good numbers, yeah.
And then it sold off. Is this your favorite situation when a stock sells off for no reason?
Yeah. I don't know if it sold off hard enough. I don't think it's down that much, and it was rallying. But Shopify's a business I've liked for a long time. And it's funny you brought that up. This is exactly what I was talking about. So here you got a company, there's no other company like Shopify. And if you want to start a business and you're a mom and pop or you're a major company, you still use Shopify. Because if you're mom and pop, they do everything for you. You can take credit cards, fulfillment, websites. It's such a good website for business. It's like a lot of major retailers just use Shopify as their back end. Okay. So Shopify is a little bit like Toast as well for the restaurant business, but Shopify is way bigger and has a way bigger reach, and they're not just in one industry, they're in every industry. They've managed to make money off of all this too. They have good margins. I think I was just looking at it. It was something like 17% operating margins and growing, and their revenue was growing at something like 25 to 30%. And you look at e-commerce, which is really not just the future, it's now, and its growth potential will continue. And then the issue with Shopify is just valuation has always been super high, that's always had a really high multiple. So now they're a profitable company with growing revenues at a very high rate with pretty solid margins that hopefully will grow. And I think it's a very attractive investment. I think they have a monopoly almost. The businesses don't leave Shopify. It's kind of what we were talking about with Apple, where it's am I really going to leave Apple? No. So if you're on Shopify, I think probably nobody leaves them. You know what I mean? They're that good of a business. So because they get a cut also from the merchant sales, they really have this incentive to see the merchants do well. So it's a win-win for the merchants, and it's a win-win for Shopify. And they've made a lot of businesses better. And when I look at, my wife runs her business through Shopify and sells through Instagram, and I look at how much she pays Shopify a year, it's a substantial amount of money. But it's worth it in that her business can run a multi-million-dollar business through this website, and she didn't have to build any software, So I think it's a great business, and if it goes down and there's some reason to its valuation, it's a great company to own.
You're right. It was actually kind of an imperceptible dip after an initial kind of freak out over what were pretty solid earnings. We're going to take a quick break here. We'll be back with more of your questions for Ross Gerber. And we're back. We've got a couple of questions in the mailbag left before we get to Ross's pro picks. This one, Ross, is about Snap. How do you see Snap performing over the next 6 months? This one coming from a question on Instagram, Drick444. What do you think about Snapchat? Are the kids still on it?
TikTok really was a blow to Snapchat. So the TikTok ban helps them. And I hope that TikTok ban continues because I think it's poisonous. It's like poison to people's brains. Snapchat is more a communication tool than per se social media. But Snapchat has suffered for a long time from a lack of direction. Management had issues. They're actually our neighbor in Santa Monica. So we know Snapchat really well. I've watched them grow up. Evan Spiegel's a West LA guy too. So I've met him and I think that business has gone as far as it's going to go. So I don't see Snapchat going away or whatever, but tell me how they double. Are there more Snapchat users they're going to get? They're in a highly competitive business for eyeballs now. And so I don't know what the strategy is, how they double. I get Reddit can sell data to AI and collect lots of revenue from those streams. I don't think Snapchat has that kind of stuff, So it'll be on people's phones, and I think they do okay with advertisers, but I just don't see it where it grows into something bigger than it is now.
I saved, I don't know if it's the best for last, but
I always used to come to you as the Tesla guy.
Right.
And you know that you were synonymous with the Tesla guy. So our last question in the mailbag is about Tesla. Nicole from Montreal. Are you worried about Elon Musk's relationship with Trump, him spending so much time on Doge, and what the impact it could have on Tesla?
Less about that than the perception that the public has for Elon. And the way that Trump's also using Elon to be the bad guy. People like Trump more than they like Elon, which is crazy. And Elon's not very socially conscious. Like, he just doesn't understand what he does and how people thinks about him, because in his mind, he's doing what's best for humanity. But people in the tech business who say they're doing what's best for humanity are full of crap. Okay, because you don't get to be the richest man in the world because you care about humanity. Okay, let's be real. He could just give all that money away to humanity right now. I got 100 things he could help right now. There's starving kids everywhere, right? So he's not helping starving kids. He's cutting the federal government and cutting jobs. And most of these jobs are regular people. So here you got the richest man in the world firing regular people left and right. The government has never been efficient in the United States since the Civil War. So like, any idiot can go in and cut expenses at the government. I mean, that's like, a blind man could do this, just point at anything and you could cut it and you'd save money. That's the government. The government's totally inept. We all know that. Fortunately, Canadians have the same problem, okay? The Canadian government is just as bad. I could go into the Canadian government right now and cut things left and right. You would be shocked, right? Why Elon's doing this, I don't know, okay? Secondly, people buy products because they want it to align with their values. And when you think about the products we love, it's because they don't create a dissonance in our morality. And Elon's created more dissonance through racism, anti-Semitism, anti-gay remarks, white supremacy, supporting white supremacist groups and political parties. The right-wing move has been way more detrimental than Doge or the government. Now, a lot of people are thinking Doge is the issue. It's not. People don't want to align. It's just like the Kanye West thing. Kanye West is one of the worst humans on earth, and Elon's like buddies with him and doesn't want to deplatform him because he doesn't have any issue with Nazis, it turns out. Well, this is really a hard way to sell cars in the world, except in China. They don't care about Nazis that much. But like, in Europe, sales are down 60%. I mean, this is like a collapse. And in California, it's down 12% and dropping quickly. And Republicans aren't buying EVs. So let's be real, that myth that all of a sudden, like, cowboy Nashville dudes are going to be driving Teslas is not going to happen. And Trump certainly isn't pushing EVs. So that's the irony, is that he's aligned himself with somebody who's trying to kill his own business. And he's fine taking away subsidies to Tesla. So Elon's been a pretty big detriment to Tesla's success over the last year or two. And we can just see it with all the numbers. And I think it's all coming to roost this year. So as a Tesla investor, which I still am, and as somebody who knows the company better than pretty much anybody, this is a wonderful company that's being led off a cliff. And it just sucks because the board won't do anything.
So why not sell? Like, if that's your opinion, and those are strong opinions, and you're such a management guy, why do you hold on?
Well, I've sold a lot of Tesla stock at a nice profit, so it wouldn't be accurate to say that I'm holding on in that sense. What it was is that we had so much Tesla, and it was such a big gain that every time I sell it, it's a tax consequence. And so, over the years, we've sold, starting in 21, and it's been 3 years. And I'm filing my 13F this week again, and we still own, because the value doubled. So I had got the position down to a place where I was comfortable. It was like 1%, 1.5% of our assets. But the reason I haven't sold is Tesla still makes the best EVs in the world and still has the best software in the world and really makes the best, products, battery storage. I'm a climate guy, and there's no better company to deal with climate change than Tesla. So as a shareholder, and what I keep telling people is 87% of Tesla is owned by people like me. Okay, individual shareholders, institutional shareholders. Elon only owns 13%, but yet he acts like he owns 100% because the board doesn't represent us. And it's not fair. And that's why the Delaware court voided his pay package twice, because they know it's bullcrap. And having your brother approve your pay package is just not the way it works in the US stock market. And so this is a big thing. And so because Tesla valuation soared after the election, there was sort of like, see, everything he's doing is great for us. But now that it's dropping, and we'll probably go back at some point to the price before the election, then people realize, well, actually this election didn't help us at all, okay? And so, should Tesla trade at 150 times earnings? Absolutely not. There's no reason for it. And should it trade at 50 times earnings like Nvidia? Yeah, probably. But 50 times earnings is like $150, $175 a share. That's not good for Tesla, right? We've taken the opportunity to sell more Tesla recently because the valuation is absurd. And even at today's price, I still think, if you want to take some profits, it's probably the valuation is absurd. But what we're most concerned about this year is that the promises of robotaxi being launched in July or August or June in Austin, if it doesn't kill people, I'll be shocked. So, this product is not ready to be unsupervised. I use it every day, and it's dangerous to use unsupervised. There's no way I'm getting in one and getting in the back seat and closing my eyes. And I'll do that in a Waymo right now. So there's Waymos all over my neighborhood. They are working very, very well. BYD just launched its own autonomous software. And one of the things you see that's different with every other company is they're using LiDAR and radar and vision systems. And that's why those systems are safe. And after years of testing and studying this, I'm convinced that Tesla hardware isn't good enough to be fully autonomous. And they will have to add radar and LiDAR like everybody else at some point if they want to be fully self-driving. And so the sooner they admit this, the better. But the longer they continue to try to build on vision-based only systems, the longer it's going to take for them to solve this.
That's a really high risk that you're putting out there, because so much does hinge on the robotaxi. So really interesting perspective there. I could talk to you so much about this, but I want to also get into your pro picks, your best ideas. Okay, now it's time for Pro Picks with Ross Gerber. This segment is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, Ross, what I love about these picks is none of them are the Mag 7. Those have been such a successful group, but we're really kind of going outside of that for ideas. And your first one is Netflix. Maybe it should be a Mag 7 because it's been so remarkable.
Well, it's a FANG. It's a FANG.
It was a FANG, yes.
Right.
And then it got kicked out when they formed a new clique, which can happen. Talk to me about why add Netflix here, whether there's still a lot of upside.
Yeah, so with Netflix, I'm happy to say it's been one of our most successful investments over time. And Netflix has run into a couple walls in its time, and then they had to adjust. And they were really successful at doing that when they went from DVDs to the internet. And then recently, it was this paid ad tier versus subscription only. And for a long time, it was like, oh, there'll never be ads on Netflix. And then they realized, like, holy moly, not everybody's going to pay $25 a month. So if we run something at $7 a month and run ads, maybe we can make a ton of money on ad dollars. Okay, so that was the first acceptance that having an ad tier made sense for Netflix. And then password sharing crackdown. So by not letting people share their passwords and creating an ad tier, they were able to add, originally they said there were 300 million users that weren't paying. And I thought that number was crazy. Like, really? That many? And it turns out it probably was. And they've signed up.
They added an insane amount in the most recent quarter.
Insane. It's like 100 million just in the last year or something of new subs. So their numbers weren't wrong that all these people weren't paying. So we used to do this in my office. We have, let's say, 50 employees. And I'd say, how many of you are paying for Netflix? And it was like, none of them. And I was like, why am I paying $25? I got to call my mom, My mom won't know if I take her Netflix subscription, right? And it turns out my mom doesn't have one. So, all these people's parents have Netflix subscriptions. So I knew once they cracked down, and sure enough, one by one, they're like, I'm paying now. And there wasn't a pushback to that. There was this fear that people would cancel their subscription, but the content is so good, people didn't. They just started paying. And if they didn't want to pay the $20, they were paying the $7 and watching ads. So what our premise was that they would make more money selling ads and charging $7 than charging $25 with no ads, which turned out to be true. Why? Because engagement on Netflix is super high. So when people are watching the ads on Netflix, it's way better than an ad on television. Because during television, even the Super Bowl, people go to the bathroom, people are talking, people are looking at their phones. But when they're watching Netflix content, they're usually pretty engaged with that content, and it's just the way it is. And so they've also, and then they recently moved into live events. So it started with comedy. And then they realized they were doing these comedy shows. They're like, oh, we can promote the shows, we can record the shows, we can make money on tickets, but then we can put it on our platform and it's a win-win. And comedy was relatively cheap compared to other content forms. And then they're like, let's do alternative sports, and once they got into sports, they realized something that was super powerful, which was that everybody in the world would watch sports instead of just people in the United States. And so if we put sports on that generally are popular for the world, we might have a much bigger audience than regular television. And that turned out to be true during the Tyson fight. So in the Tyson-Jake Paul fight, more people watched that fight than any fight in history. And then they do a couple NFL games, and it's the highest ratings the NFL has got. And it turns out the Beyonce Bowl was better than the halftime show at the Super Bowl. And
it was so good, the Beyonce Bowl.
It was great. It was great.
Amazing.
And then I watched Kendrick, and I was like, "This is the worst thing I've ever seen." It's like it's the opposite of entertainment. And I was like,
I just want to move
okay,
on.
So
I want
anyways,
to ask.
The moral is
go
they're
ahead.
just getting started here, and we think they can get to 500,000 subscribers. 500 million.
Okay, so an 80% gain over the last year. You see more upside this year. If the analysts are right, Amazon for the first time will make more revenue than Walmart. But your pick is Walmart. Tell me why.
Well, I think Walmart makes more margin than Amazon on that revenue. And you have to look at Amazon too as several businesses, because AWS is actually the best business Amazon has, which is web services. And now their ad and entertainment business is doing very well, and is probably one of the greatest sources of the growth is actually ad revenue, just like Netflix. So Amazon Prime is starting to pay off for them, and also with sports and football. But Amazon's core business, groceries and delivery, they've gotten more margin out of it, but it's a tough business. Walmart is the opposite of Amazon because it is the central place in people's lives in most cities in America. So in most cities in America, you go to the Walmart if you want to go to get groceries, if you want to get anything. And it's kind of like the place to go. But Walmart created a digital business. So it was like opposite of Amazon. They started off being bricks and mortar, getting disrupted by Amazon, but then they fought back and they built a digital business that's doing quite well. And so their digital business has really grown. Walmart's management is super good. Like they're just super tight. They've really made the business lean and growth focused and very profitable. I've been very impressed by management, but what it is, Amazon is a consumer staple. Walmart's a consumer staple. And so when inflation goes up, when people are concerned about costs, they go more to Costco and Walmart. So Costco is another play which we don't own. It's a higher valuation than Walmart, but also a really good company. And so they're both extremely well-run companies.
I just want to pause on that because Walmart is expensive. It's a staple, but now you're paying 40 times earnings
Exactly.
for it.
It's expensive.
You still think there's upside?
Yeah, I do. And I just bought more, this week. And I think it's because they have this monetizable upside that is limitless. So the more that prices go up for inflationary prices, the more people go to Walmart and Costco and other places that are cheaper. And what I actually think is that Amazon is less, people like to go to stores and people want to go to the center of town and be around people, and they want to shop online. And I think Walmart has been successful in capturing that multi-channel business where Amazon never has been successful selling out of stores. And so there's a lot of people want to go to a store, and Walmart's the center of town, and they go to the Walmart and they go shopping for groceries, but they're buying lots of other stuff too. But the prices are lower, and so the demand is just continuing to increase.
All right, let's get to Eli Lilly. Super interesting. Obviously, we know Ozempic, made by Novo Nordisk. Eli Lilly has a competitor version of that. Both these stocks rocketed to the moon on enthusiasm, and then they have pulled back.
Right.
And then they rallied a little bit, especially in the case of Eli Lilly. So what's going on with Lilly? Why do you want to add it here? Can it get back to where it was? Or is the kind of craze and excitement around those weight loss shots and pills over?
Well, I'm in LA, so I can safely tell you that the craze for weight loss is not over, and Ozempic is growing like crazy. And we own Novo Nordisk as well, and that stock is cheaper than Lilly from a valuation perspective. But the problem with Novo is it's kind of a one-trick pony around GLP-1 drugs, which are these weight loss drugs, where Lilly has the GLP-1 business, which is really good, but they have other drugs in other areas that they're also leading in. So you have more diversification away from just weight loss drugs. But my basic premise, because we own both, we added Lilly on the weakness because the valuation was twice that of Novo. And so, it's still twice that of Novo, but we took the opportunity in the 700s and low 800s. But even in here, I think the stock is worth buying because I just read the stat in the earnings report. There's something like 55 million obese Americans, and only 1.5 million of them are taking weight loss drugs currently. And so the market for obesity is massive. I know that that's kind of a weird way to say it, but, couldn't be bigger, And so when you look at markets like China, where they also have, 50 to 100 million obese people, and then you look at obesity across the globe, just even within America or North America, the market could double, triple, quadruple over time. And what we found, and it seems obvious, is if you're overweight or obese, you're going to die younger than non-obese people, and you're going to have substantially more healthcare issues. Substantially. I mean, it's just like obesity is a really bad epidemic, let's say. And so these drugs do have side effects. They're not perfect, but the side effects are minimal compared to the health benefits, which are incredible for people. So if you can lose 20 or 30% it's really about 20% of your body weight by taking these drugs, we highly recommend people do this because all the other sicknesses, it's just sinking our healthcare system. So obese people are sinking the healthcare system. So what we think is governments, healthcare companies, and everybody's going to cover this over time because it's a massive epidemic that needs to be solved.
Ross, thank you so much for joining us on the show. Your stories about stocks and the people behind them, so invaluable. I appreciate it.
Thanks for having me.
That was Ross Gerber of Gerber Kawasaki. Make sure you join us on the next episode. We've got Evan Manser of Cardinal Capital, and he's a fund manager based in Canada, around $4 billion in assets. And lately, he's been dabbling in some really interesting activist investing. We're going to talk about that and some of his best ideas in the space. If you've got questions, you can find us anywhere on social media, In the Money Pod, or you can submit your questions at inthemoneypod.com, and of course through our website, www.inthemoneypod.com. And we'll catch you on our next episode.